All right, guys, wanted to start off with today and really go over why I think real estate is just a better asset to invest money into. What they've been dealing with, especially all week, has been dealing with Apple. Their stocks are down. They've been hit hard. They're talking about pretty much staying put, regardless of what the tariffs are talking about. Walmart got passed on, and President Trump basically told him, "Hey, you're gonna have to suck up the tariffs." Right? That's happening all around us. As a matter of fact, if you look at housing starts and stops. They've been pretty much tough. The people who are doing the best right now, as it relates to the housing market is concerned, single family houses, especially purchasing, is builders. Builders have been actually able to compete a lot better with single family homeowners, even though there's this spike in purchasing. But builders are actually pushing because they can actually do what they need to do. They can do their own in-house financing. They can buy down rates. They can bring people down. As a matter of fact, this week the interest rates on single family houses jumped all the way up to 7%. So that had everybody worried, as well as not only interest rates for mortgages went up closer to 7%. The 10-year treasury jumped up to 5, and then it backed off. It's at 4.5 now. But that matters as it relates to real estate is concerned. And really, from a real estate perspective, we're talking about the big institutional banks, how they play the game, what they're doing, which really sidelined a lot of them, right? But how does that work for you guys as regular people, everyday people, business owners, hardworking people that have to get out there and do stuff? Your investments are affected by this. So if the stock market goes down and in your retirement account, your 401k IRA is tied to that, that's how you invest your money. It's tied to the stock market. Your retirement is losing value all the time. You have this ebb and flow up and down. So no matter how hard you work, depending on how old you are, 40 years old, 50 years old, 10 years from now, when you're 65, 72 years old, whatever, you want to make sure that you have retirement put away and you can't keep up with the craziness going on because this is cyclical. This will happen every 10 years. Every 10 years, there's an economic problem, or every 10 to 15 years, there's a debt problem. And during those times, what happens? Inflation goes nuts. They print a bunch of money. They print a bunch of money before it happens, and then they pull back because they need you to spend it. It can't just sit in your bank account. They raise interest rates, so you have to spend your savings, and then the cost of goods goes up. So the cost of what your dollar could buy, the money that they printed and gave to you, that money buys a lot less. It happens every time. Values go up on homes, values goes up on cars, credit card information, credit card money is easier to get, loans are easier to get, then it stops, right? That's the Fed, really, which is crooked, strangling the everyday American. So you cannot function and do anything because they're trying to reset the clock to get things back where they are. That affects you. So I bring that up to say this. If you're going to put your money in a place, you want to put it in a place where you can control the outcome. There's some stability. Real estate, to me, and I'm talking about all real estate is not created equal. There's single family houses, there's retail, there's office, there's vacant land, there's industrial. We're talking about multifamily properties. That real estate, that asset class has been stabilized for a really long time. It has always been the belle of the ball. Fannie Mae, Freddie Mac, life insurance companies, debt funds, Wall Street, local regional banks, all of them love to lend money on that. Why? Because people will always need housing. It doesn't matter what they do here. If you guys didn't notice, last week the stock market went down. What's going to happen on the first? People are going to pay their rent. They're going to continue to do that. There's never going to be a time where people are like, hey, you know what? We're tapping out. There has been a time, but that was because there was some disruption in Wall Street. That had nothing to do with the economy as it relates to the people. The people are the economy, right? The original definition of an economy meant the income of a household. It wasn't the economy from a global or national scale. It's different. So, reason why I say this is because multifamily real estate as an asset class beats every other one. It beats cash in the bank, right? The bank sold you on leaving cash in the bank, so they can take your money and they can lend that money out 9 times to other people and pay you nothing on your money, even though the 9 times that they lend it out is lent out times 7. So 63% on your money, you get 0.002. Maybe you'll get 4% if you're a big time player and you got a bunch of money sitting in there. But even then, you get taxed on the earn. So the cash game that they sold to you was really not for you, it was for the bank. Saving money was for the bank. It's a product. The mortgages that they sold to you. The mortgage Banks are only open because of mortgages. They're not open because you save money there. They're able to create a product, which is mortgages. Go buy houses, live a piece of the American dream, go buy your own home. You get a mortgage and we lock you down for 30 years. And every year we get 6%. Right now it's 7% or 6%. Every year you're going to pay 7% on that money. So that means in 30 years you will pay 210% just in interest while you're doing that, right? That's the game for them. And they know you're going to recycle it every 10 years. You're going to refinance, reset that clock, get your rate up and or down, doesn't matter, but they're locking you in and you never own your home. The bank owns your home. And if you doubt it, don't pay on it. It will go to foreclosure. They'll take it. All right. Next, what else? Retirement accounts, 401ks, IRAs. Also, a product of Wall Street and advisors and financial advisors. What they are, and the IRS. The IRS says, "Hey, look, we won't tax it. We'll create a product. You guys can sell it. We won't tax that money, or we can tax it and then you can put it there and we'll let it wait, right? So we'll let that save up. And then when you take it out later, when you get that money, you will be moved into a higher tax bracket. Now, taxes right now, Donald Trump has this big, beautiful tax bill. I hope it passes just because of the bonus depreciation. Granted, they're saying, hey, look, now you won't get taxed on your tax on tips. You won't get taxed on Social Security. Those are great things. But the real reason why that's going to pass is because the bonus depreciation for real estate, for big commercial grade real estate, because bigger people who play a bigger game in investments get to write off all of the money that they've invested, all of the gains that they got from there, and it gets passed back on and it can get kicked down the road. That's really what that's about. And you want that. Why? For people who say, I don't want that, well, you better want that because you want to have your money invested in something that you get the tax advantages, which I'm going to go over in a second. So, anyways, so your retirement account, like when you hit 72 years old, there's a maximum withdrawal of 4%. So let's say you're 70 something years old, 72 years old, and you live another 20 years. Let's say 20, 24, 20, let's say you live 25 years because that's possible. AI, technology, health, all that stuff's getting better, right? Um, let's say you live that time. If you have to withdraw 4% every year for the next 20, that's 100% of your money that you've been saving. You have to draw that out. And oh, by the way, if you're that age, which that's possible, my grandmother lived till 90. Everyone you know is living till 90, 95. People are pushing around. You will have none of your principal balance. The whole goal here for you to put money into retirement, one, not pay taxes on it. Two, still have some money for you to live off of the lifestyle that you need to. And if that's the game that the IRS says, hey, we'll hit them later, and the financial advisors get to hit you for a bunch of fees while they're managed this account, while it's tethered to, well, that's commercial now, while it's tethered to Wall Street, because that's where they're going to put your money. If your money's not in a real asset, real estate, it is in Wall Street, period. Mutual fund, growth fund, index fund, ETFs, all that other stuff, it is in Wall Street. No matter what you think it's in, it's tethered to Wall Street. Whatever company it's there. And if those company values go down, like Apple went down, Wall Street went, Walmart shares went down, Tesla went down. Let's see. All of this, there's only seven stocks that are really holding up to S&P 500 anyways. So I think they're talking about, yeah, new home stuff right now. That stuff that I'm talking about, that's a challenge for you. That's why I said like that stuff was your retirement account really is a product of Wall Street. Your mortgage is a product of Wall Street. Your retirement accounts are a product of Wall Street. Bank savings is a product of Wall Street. All of it is. All right. So the only one right now that's really crushing it is Bitcoin. Bitcoin went up to I think 110,000, which I had never done. It was its highest, and then it came back down. That's a volatility there. And here's the thing about Bitcoin: you cannot buy enough Bitcoin as an individual to really make a dent. The people who are making a dent are BlackRock. I think JP Morgan, Jamie Dimon came out and said, finally, hey, look, we'll allow our clients to buy crypto. That's who's going to win that game. So if you're a small player, you can't buy enough to make a dent in the Bitcoin game or the crypto game. Even though it's great and you can have it as a part of your portfolio, it's still not going to, it's volatile. It has extremes ups and downs. It was at 106 or 9, then it dropped all the way to 86,000. So no matter how much money you had there, you had to lose something to get back to 100 to now gain. You needed a 200% gain, not a 100% gain, right? Huge. So now, I talk about single family houses outside of the mortgage, all the other stuff. Your single family house, that is the other place that people say, well, I'm going to invest in a single family house. It's not an investment. If it's a primary residence, it isn't an investment. You can live there. You can hope it goes up. It may not, but it may not. There you go. So This is the reason why I think multifamily real estate's better than all asset classes. I won't go through all the other ones. I can get hot and heavy, but because I like talking about this, I like expressing this to you guys, and I'll slow this part down because I really want you to get it. All right. So number one, real estate itself is a real asset. It's not a stock. It's not a paper. You're not taking your paper and trading it for paper, or you're not taking a digit and trading it for another digit by pressing a button, right? There's a real address. There's people that live there, and 9 times out of 10, it's probably been there for a long time, which is next, right? I talk about it being proven, but it's real. You can look it up. You can Google it. You can drive by it. You can drive through the parking lot. You can see people living in a multifamily real estate asset, right? Because there's one down the street that we looked at. It was 112 units. It's full. People live there. People live across the street. People are walking their dogs, playing with their kids, picking up their dog shit like they're supposed to be doing the right way. All of that matters when you talk about investing your money in a place. If you take your money out of the bank and you treat a multifamily real estate asset as an investment like a bank and you move your money to it, you know where your money is. You don't know where your money is in the bank. If you have to go there, you can pull it out. That's not your money that you pulled out. That's somebody else's money that they gave you back, right? That's why if you could try to go get anywhere above $10,000 out of an account, your savings account, they're going to tell you, and you want cash, they're going to tell you come back the next day. Your money ain't there no more. So, first, it's real. Number two, it's proven. Real estate itself, as an asset class, is been around for thousands and thousands of years, biblical times, right? All like the Vatican. As a matter of fact, the Vatican is, I want to say, is 2,000 years old. That place has been pumping out money for 2,000 years. There's properties that I've seen that were built in 1920s that are still, that people live there, multifamily properties that they are still kicking out, puking out money every month. So it's a proven asset class. It cannot be denied. Jesus, Moses, the children of Israel, all of them fought over what? Real estate. It wasn't biblical stuff. It's just written in the Bible. But if you miss that part, that real estate itself is a proven asset class. It's been around for thousands of years. When people move, they move into a real estate piece. That's just what they do. Now we're talking multifamily real estate as an investment. People need a place to live. That'll never go away. So your money is safer in real estate than it is in any other asset class. Next, it protects your capital. Like I said, if you take your paper and trade it for paper, that's not protection because that stock that you bought could go to zero. There's a lot of stocks that went to zero last week. $6 trillion just within the last couple of months went away out of the stock market. That value of those companies, that value of those stock shares, some of them went to zero. There's zombie companies that have no income revenue at all. They're just a shell company. They have debt, or they have debt. Sears was a zombie company for years before it shut down. I think there's a couple left. Blockbuster, a zombie company because it had more debt than it had income and inventory, and eventually it went bankrupt. A lot of people are tied to these things. So when you're in real estate, it protects your capital. Let's say we bought a property for $100 million, hypothetically. We put down $40 million and we got debt for $60 million. It would take an act of God before that asset, the damage to that asset, financially, economically, would actually have to eat through $60 million worth of debt before it hit $40 million worth of capital. That's what I'm saying. Like, it protects your capital. You know where your money is. It's not just going to go away, right? You can't steal it, right? Like FTX, Sam, the Sam guy that went to prison that stole all those people's crypto. Like, if that money would have been actually secured to real estate, if he would have took everyone's crypto and bought a bunch of real estate with it, he wouldn't have been able to steal all of it. There would have been something to liquidate. It wouldn't have just boom gone like that. All right. Next, it's long-term investments. Like if you listen to Larry Fink over at BlackRock, what does he talk about? Long-term investments. Why does he believe in long-term investors? Because their company is long-term holders of people's retirement accounts in the ETF world, right? They deal with like banks, life insurance companies globally across the world. They have 11 trillion dollars worth of assets under management. The majority of it is long-term retirement from companies, people who do the bank deposits, things like that. That's what their people are. And they believe in long-term. That's what he says. It's all long-term, like meaning life. You're going to put your money there and leave it there. That is why I believe real estate's the same way, because if we let's say we bought a building today. 2025, we bought a building today that was built in 2023 or 2020 or whatever. The thought process is that property will not just go away. It has to be torn down. It has to be demoed, torn down. That costs money. That takes time. And the land underneath is still going to be there and it's probably going to be built up for something else. It can't just be taken away. So your long-term play in investing your money is through the real estate. All right. So next, and this is the stuff everyone likes to talk about, but they miss these other things, why it's so important. That is the passive income. You get passive income if you're investing in like kind of like we have here. When we purchase existing income producing assets, that's what you want. You want existing asset. It already has income. I have friends of mine and people that I know that build. I have people that I met here that are building some really massive office stuff. And my question is like, who's paying for this party? You got to ask that. But if you invest in something that's already income producing, it's passive to you, meaning like you're not there, you're not showing up every day, you're not a property manager, you are investing money and it kicks out passive income to you, and all you're doing is get on the phone and checking your bank account occasionally per month. That's really what you're looking for. But real estate can provide that. Right? Most stocks don't pay, Apple's not paying a dividend. Ford Motor Company is probably going to go out of business here soon. Let's see what else. Even some of the REITs pay a dividend, but like I said, even if you're getting a dividend, that's not a distribution. A distribution means you're a partner. A dividend means that you're getting a piece back from a stock, a share. All right. And I did that video. You can go back and watch that video on the 4 ways to get invested in real estate. One of them was to invest in a REIT, which is really paper, which is not investing in real estate itself. All right. So the next thing people like is the tax advantages. I just talked about the big, beautiful bill. That's coming up. The 100% depreciation is probably going to come back. It's already passed. I want to say through Congress. Now it's got to go to the Senate or one or the other. It went through the Senate. Now it's got to go through Congress. I really, truly believe it's going to pass. Here's why. And I'm going through this as a tax advantages. Because if you haven't noticed, Donald Trump's a freaking brilliant negotiator. When he negotiates, he asks for a ton of shit. I do it too. I'm like, I want this and I want this and I want this and I want this. But here's the deal. When you negotiate in your professional negotiator, you ask for a lot of stuff, but those are throwaway things. You really don't want that. There's one or two things you really want. The bonus 100% bonus depreciation he wants, the tax cuts he wants, and I want to say there was something else. All the Medicaid stuff, they're going to fight that. They're going to be like, hey, you can't do this for Medicaid. You're not going to be able to cut people off of their SNAP, or they're going to not be able to get food stamps and stuff like that. Basically, they're not going to get it, but they're going to have to actually work somehow or put themselves in a situation where they're not stuck on assistance all the time, which is a drain on the economy, right? So, but anyways, I bring that up because the tax advantages do get spread back to you. Because if let's say you're a partner in a deal, and there's 100% depreciation, there's 100% bonus depreciation again. Let's say you paid, same example, $100 million for a deal. You're a limited partner in the deal. It's you and 100 other people. You guys put in the $40 million together collectively. I got the debt on the property. Now we get to write off in that first year $100 million of that asset per the purchase price, and that gets spread back to our investors. And whatever's left over, you get to keep that and use it the next year and the next year and the next year. That's the advantages. That's why the wealthy continue to invest their money in real estate. There's no other asset class that allows you to do that. None. Zero. Nothing. So that's the benefit of that. And then next, you get to control your appreciation, your future appreciation. That's why I don't like the stock market. You can't control that, right? They're talking about right now like how Trump escalates Apple tariffs. You can't so that means the Apple stocks went down. You can't control what's going to happen. Yes, values will come back up, but you can't control it. With real estate or multifamily real estate, I can increase the rent, I can lower the expenses, I can dispute the taxes, I can get a blanket policy for our insurance over a portfolio and lower our expenses on our insurance costs. All of those things force appreciation, appreciated value, because multifamily real estate is actually valued by its income, by the revenue, right? And naturally by the returns and things like that. Cap rates is a bunch of other things. Don't get confused. But what I'm talking about right now is we get to control the future appreciation of that asset because we can do what's called forced appreciation or force the value or add value by increasing the income. And that's how you increase the value of the assets. It's not like a single family house. And last but not least, it's an inflation hedge. Look, if you have real assets, you want inflation. You don't not want inflation. You want the cost of lumber to go up, glass to go up, steel to go up, labor costs for people to go up. You want all that stuff to go up because as it gives you a natural lift in if it costs more, then your real assets begin to be worth more without you pushing on them. Right? That's valuable to know because when you start understanding what's really happened, look, don't get confused with watching Wall Street. CNBC is great. They're going to give you this. I talk about it all the time. They can come online and they can say, they had Apple phones. If you keep your Apple phone in your pocket too close next to your genitalia, it's gonna burn your genitalia off, and you're gonna have less sperm count and blah 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 because of radiation from the battery. Apple stocks will plummet. Period. You know what won't plummet during that month or that time based on that bad headline, whether it's true or whether it's not, because people get scared? Your real estate. Your real estate investments will not go down during that time. Why? Because people don't give a shit about Apple stocks. They're going to be like, hey, I need a roof over my head that's safe, that's clean, that's near hospitals, near good schools, near entertainment, in a city that's continuing to grow. That's what matters. So if you can actually put a block on that thought, that real estate as a stable investment outside of what's happening in the market is a better place to have your money than crooked Wall Street. And depending on the retirement for you and your family in the future, and going ahead and moving your money into a real asset that if you can believe that that's better for you, then I want to convince you of that all the time. That is my holy crusade at this moment. Is to revolutionize the way that people invest in real estate instead of depending on Wall Street for their retirement and their future for their families. I'm going to do that. That is my purpose. I will not stop, and I want to do that with you guys. So, long video, but I love this stuff because I'm really trying to convince you that this is the way that you need to be. Like whether you do this with me, you do it with somebody else, this still needs to be something because I wish somebody had taught me this. One, if somebody taught me this when I was younger, I'd have $10 billion worth of real estate already. I would have never, ever bought a single family house because I was buying them and selling them, and or the multifamily properties that I did, small ones too, I'd still have them. I would have never sold. I would have refinanced them, pull my money out the way that I'm looking to do with the fund, and pay my investors back. And I would have flipped into more deals, but I would have never stopped. I would have never bought single family. I would have only kept my multifamily and only bought them. And oh, by the way, I would have had a lot more partners. I would have raised money. I would have partnered with you guys. I would have made sure to have this conversation. Get your money out of crooked Wall Street. Don't depend on them for your retirement and move your money into real estate. And I would have thousands of investors, thousands of units, probably $10 billion worth of real estate, but we would all do that together and we would basically score one against Wall Street because Wall Street doesn't want Victor Bell competing. They don't want to compete with Victor. They don't want me involved at all. Right? That's why they make it so hard to talk to you guys because they want to keep you for themselves. Either they want you for themselves, Wall Street does, or they want to continue to be the middleman in between you and the brokers or the advisors or the RIAs that are controlling your money because that's their game. They purposely exclude the little guy from the top. 80% of Wall Street stuff, all the stuff you see, 80% of Wall Street investors are institutions. They're not little people. So when you see these big swings, they're not talking about you guys. You might have 100 shares, 1,000 shares, or something that's tied to your mutual funds. But aside from that, you're invested in Fidelity, Vanguard, BlackRock, Merrill Lynch, all the other companies that actually control this. They're Wall Street companies. Don't get it twisted. That's just how this game works. All right. So, but I'm here to tell you guys the truth because I'm learning the truth. The more truth I have, the more truth I can tell. My YouTube channel is not going to get shut off. Nobody's going to come stop me from Wall Street yet. Yet. Hope not. But anyways, I'm doing this because I want to help. I'm doing this because I want you involved. And I'm doing this so I educate you, whether it's now or in the future. I want you to look back and be like, hey, that guy actually made things simple for me to understand because I'm a simple guy. And I appreciate that. I needed that rather than this thing back here that's super confusing. Because if you're not a part of that game, you ain't going to play it. All right. So I hope this helps. Like this video, share the video, comment on the video. My goal is to get my subscribers up. We're already to 230,000 views. We had a goal of 200,000 views, or I did. And now we want to get to 1 million views. And I can't do that by myself. I want you doing this. So like the video, share the video, comment on the video, subscribe to the channel, share this video with somebody who needs to see it. You got somebody that their money is going down all the time in their retirement accounts, their IRAs, their 401ks. They're invested in other stuff and they're playing this weird game. You owe it to them. It is your ethical responsibility to help them create wealth for themselves and some stability for their family for the future. Real estate can do that. I don't know about all these other ones. I don't play that game. I only know how to play this one. All right. And I want to help you play it too. All right. Let me know if you need anything. Go to bell-capital.com. That's bell-capital.com. You can get started. You can see what we have that's open, the open fund. You got to be accredited, got to have a good attitude, got to love real estate, got to be a long-term thinker, or you can schedule a call. Myself, somebody on my team will get on the phone with you, answer any questions you have, and make sure we can get you squared away. All right. So looking forward to having you guys, seeing you guys. What did you take away from this? Put it in the comments. Out of the things that I talked about, being a stable investment opportunity, better than the other ones. What is the thing that you walked away was like, oh man, you know what? He's right. Or oh man, Victor, you're freaking nuts. Like you're nuts. You're off. You're this. I want all of it. I want to see what you're talking about so we can communicate. That's my goal here. All right. Have a great day today. Let's get after it. Boom.